Welcome to the Healthy and Wealthy Retirement. My name is Mark Struthers. Thank you for joining us. Today we're talking cash flows pre-retirement. And we're not going to go through numbers. The goal of this exercise, the goal of this YouTube channel is to start to get you thinking about financial planning, really. Ideally, everyone should kind of have a full financial plan done, either on your own or with an advisor. Somewhere between probably 7 to 10 years, definitely 5 years out. 3 gets a little dicey. If everything looks fairly good, 3 years isn't bad, but then the biggest risk is that you can't change anything. The problem is doing a full plan is very expensive. It's very to hire a true fiduciary professional that's not going to try to get paid through commissions or on the back ends to get objective advice costs thousands because it's the expertise and the time involved is so great. A lot of people don't have that money for that, or they don't have the time, because even if you hire someone, it still takes time on your part to gather the documents, to engage in the conversations. I'm always amazed at folks who don't want to be involved in the conversations around what judgments are made in for a financial plan in retirement, where you're talking about 30, to have no idea the risk you're taking on with inflation, with your investments and so on. But that being said, one good exercise is for folks to start thinking about cash flow. And it works because it starts to get you not just thinking about the numbers, but also the emotions. Because then if you start thinking about cash flow, you start thinking about what am I going to do in retirement? And this is a transition period. And my first major was aviation. Most accidents happened in transitions. They usually don't happen in steady state flight. They happen in transitions during takeoffs and landings. Unfortunately, some of those have been in the news recently. So if you could start thinking about cash flow, a lot of times folks come to us, we do one-time financial plans as well. And most often it is someone who is preparing for retirement. They often just haven't put any thought into it. And it's understandable. Quite often they have no idea what they're spending. They have no idea what they might spend in retirement. They really, and a lot of times they're not in bad shape. Sometimes very good shape. Maybe they need to tweak a few things. Sometimes it's a rough shape, but even those in good shape often just really have no idea what their cash flow is. Starting to put some thought into that is a good first step. Don't get too bogged down in the numbers necessarily. To start off tracking. When we used to work more with employee financial well-being and we used to do a lot of budgeting classes, the first step is just to track. Don't beat yourself up. Don't take on too much, but just to track. Because you figure your transition to retirement is different. It was different for baby boomers who often had pensions. Inflation was less of an issue for the most part. Now, granted, in the 70s, inflation was quite high, but quite often their time in retirement, they were only planning for 15 or 20 years for folks from the older baby boomers to is it the silent generation or before? I think about a Gen X or my own parents. It's quite often they're retiring in their mid 60s, and they were most often they're lucky to make it to 80. I mean, the numbers are the numbers. If they once they got into their early 80s, you kind of were thankful for any years you had left. So when you think about transition, you can start thinking about location preferences, desired lifestyle. Some folks move to low tax states. That could a cash flow issue. Really, everything is a cash flow issue. When you think about your investments, the investments are there to produce cash flow. They're kicking off yields, or you plan on distributions. Some of those distributions might be RMDs. You can think about your desired lifestyle. Are you going to travel a lot? That costs money. Are you going to play pickleball? What's your daily activities? And cash flow is a way to start thinking about that, because cash flows are at the center of everything. Oftentimes you find there are a lot of people who have a lot of assets that maybe aren't liquid. Could be in a private business or something. So even though they might have a large net worth, their cash flow might be challenged because they can't get cash flow from that. You could have a ton of gold, but unless you can sell that gold on a regular basis, you know. So starting to think about those things, the desired lifestyle, daily activities, and then that plays in, it starts to get you thinking about your savings adequacy and financial flexibility. Do you have an emergency fund? It also starts, maybe you pay more attention to your investments, uh, you know, realizing what you have, where they are. Sometimes Folks often have two major things when folks come to us who are doing one-time plans, they don't have the ongoing guidance, the tweaking, the proactive stuff, which it's a lot easier to act when you have someone out there reminding you, knowing they're there to say, hey, consolidate accounts. So folks come to us having really often no idea what they're spending, and they have 15 accounts all over the place. They don't really have an idea of where things are at, and there's no overall portfolio analysis. They could have 80% of their net worth in the semiconductor stocks, and a lot of times they're oblivious to it because it's happened so gradually. So cash flowing is a way of starting you to think about these things, and it's really critical for pre-retirement preparation because you are going from a world of budgeting where you are trying to save and invest and pay for kid stuff, and you're operating on a scarcity model, to you are starting to think about, how do I spend? So instead of budgeting, you're thinking about, how do I spend down my assets and how do my goals factor in? So once you start going with the cash flow planning, you can certainly dive into the numbers. Ideally thinking about, where are things coming from? Ideally start just tracking what's coming in, what's going out, what assets do I have to leverage? It also starts to think, what's the role, if you have a pension, what's the role of the pension? And one of the biggest things folks miss with pensions is, what's the inflation adjustment? How does that cash flow change? If you have, you figure if you have a pension with no inflation adjustment, it's a little unusual. Usually it's about 1.5%. But inflation runs at, say, 3%. So you're losing 3% purchasing power in a year. Once you start to wrap your arms around, after 24 years, we'll call it roughly 25 years, definitely over 30 years, your purchasing power is probably going to be cut in half. So you might have a $5,000 a month pension that values a basket of goods now, but towards the end of retirement, that same $5,000 will only buy $2,500 worth of goods. You can only buy half the goods you could before. So that's where thinking about cash flow is a good way to do it. And if you can start tracking, looking at expenses, there's so many tools out there now, from apps to things like Tiller, spreadsheets, Google Docs, because they're updated and shared online. It's good for spouses. So you can put things in there, and there's, with AI and all the kind of preset tools they have, there really is no reason to at least start to track. Don't make any judgments about spending. Don't judge your spouse. The goal here is, ideally, if you're starting early, pre-retirement, is to say, what does this cash flow look like? What's coming in? Where's it going? And then once you get a feel for that, then maybe you could start to say, I need to make adjustments. Eventually, you're doing some form of a full financial plan. You at least think about, what's my cash flow now? Do I need to make adjustments to get to a number? Do I need to delay retirement from age 60 to 62 to 65? And then goal setting around that, think about the short-term and long-term objectives, buying a car, traveling, leaving a legacy. And the idea, if you do start 10 years out, but even shorter, 7 years is not a short time. You can do quite a bit in 7 years. And just take it, this is where having an expert is helpful, but to say it is 5 years, what can I possibly get to? Do I need to take on risk? What does that look like? The tough part is when people wait too long and they feel like they have to catch up. Sometimes the savings rate that they have to get to is so large that maybe it's not enough, or it's too draconian, or they need to take on a lot of risk, which often they feel like they don't have to. If you can answer those questions yourself and come up with a plan, that's great. But that's why the earlier you start, the better. Now, once you get beyond 10 years out, that gets to be a longer. Sometimes it's tough for folks to really spend a lot of time on it if they're talking about 15 years out. It's tough for them to stick to it. But if you're talking 10 years out, even 7 years out, it's long enough to where you have some time to do something about it, but short enough to where there's some urgency that you're going to stick to it. And also, probably at that point in your life, maybe the kids are out of the house, there's less demands on your time. Other strategic considerations when you start thinking about cash flows and mapping things out: managing your debt, maybe refinancing options. Do you pay down the debt? The answer isn't always no. Often it isn't always yes. Sometimes it might be better off to have that flexibility, especially if it's cheap debt. Looking at taxes, starting to feel for, not just your taxes now, but what are taxes in retirement? Are Roths a good option? what can I do to limit the taxes maybe deeper in retirement? Do I want to pay more tax now, less tax later? How do I fill up those buckets so I pay less? Tax location. Should some assets be in lower tax profile accounts? You see that big, it's a lot with taxable accounts versus IRAs or Roths or 401ks. And then if you do feel like you are going to kind of do a full plan, have progress checks, have accountability. A spouse is good for this. Say, hey, 10 years out, we're gonna start mapping cash flows, tracking things, putting some thought into it, throwing some thought into what retirement looks like. Are we going to retire up north here in Minnesota? Are we going to retire down south? Are we going to do like my grandparents did, where they were snowbirds? Summers in northern Minnesota, winters in Florida. Tracking cash flows, and really don't take on too much, but even just doing that can get you and the spouse and the family talking about what do you have, where are things going, and what might the future look like. The finances are only one part of it. The cash flows can be a catalyst to start talking about what does our life look like together. How do the kids factor in? How do you and what do you want to do? Sometimes the spouses have no idea to say, I want to live in a metro area and go to the theater all the time and go out to eat. Other ones, want to hunt and fish up north. So if you start those conversations early, the better. 10 years, 7 to 10 years is not a horrible time frame out, even 5 to 10. Better late than never. If you can start 20, 30 years out, that's probably good as long as you can kind of stick with it. Do regular checks. What are your goals? Have they changed? Automate some of the things. So if you are budgeting or investing more, automate as much as you can. That also helps with a kind of estate planning, that if one spouse gets sick, if everything is set up, and especially if there are instructions that are easy to follow, we have estate planning binders that are designed for that, to document everything. The easier it is for someone to take over if you were to become ill. Doing something is better than nothing. Ideally, you should be aligning your planning stages with your current life stage. So if you're 10 years out, you need to be thinking about, what does retirement look like? What number do I need to get to with all my resources? And that might be home equity, pensions, whatever. Maybe there's a good chance of inheritance coming. Be careful on counting on that. I've seen some bad cases there. But ideally aligning that, and then if it is, say you're 10 years out, do I need to save more? Do I need to save less? Should I enjoy myself more? Professional help can certainly help, because it gives you more confidence in whatever course of action you have. uh, Making an effort to just start tracking cash flow, what's coming in, what's going out, and then diving deeper to do some level of financial plan for now and then at retirement is a good thing. But cash flow is a good place to start. It's about making an informed decision. And because everything kind of centers around cash flow, that's a good place to start. So you have a healthier, a wealthier, and a happier retirement. Don't forget to hit subscribe. Hit it.